Hey everyone, welcome back to Corporate Decoder, the place where we break down SEC filings so you don't have to. But today we're diving into an investment fund that's got some serious global reach and a name that's pretty descriptive: MFS, Global Opportunistic Bond Fund. So buckle up because we're going to decode what's really going on behind the numbers. And before we dive deep into the financial nitty-gritty, if you appreciate these kind of unfiltered insights from corporate documents, make sure you hit that subscribe button and ring that notification bell. Also, we have a fantastic community over on Discord where we unpack these filings together. So definitely check that link out in the description below. Alright, so what are we looking at here? This is basically a shareholder report for the fund MFS Global Opportunistic Bond Fund for the period ending May 31st, 2025. Think of it as a postcard from the fund managers telling investors how things went and what's in their wallet. Now, the fund itself aims to invest globally in bonds, and the name opportunistic tells you they're looking for any good deals wherever they might be. They've got different classes of shares like ABCI R1, R2, R3, R4, and R6, which basically means different fee structures for different types of investors. Let's jump straight into some key figures. As of May 31st, 2025, the fund had net assets of a whopping 967, which means 79969. That's nearly $1 billion, a lot of money being managed here. They had a total number of holdings at 967, which means they're spread across almost 1,000 different investments, a pretty diversified portfolio. And get this, their portfolio turnover rate was 66%. That means they bought and sold about 2/3 of their holdings during this period. For a bond fund, that's quite a bit of activity, suggesting they are indeed being opportunistic, trying to capitalize on market movements. Now let's peek under the hood at how this nearly $1 billion is structured. Looking at the portfolio structure, we see fixed income making up a significant chunk. They have a long position of 130.9% and a short position of negative 12.6% for a net position of 11, meaning they're holding more in investments than they have in net assets. Is a common strategy for bond funds to try and boost returns. This kind of leverage, meaning they're holding more in investments than they have in net assets, is a common strategy for bond funds to try and boost returns. The other category shows a large negative net position of negative 21.3%, which is mainly due to derivative positions they hold likely to manage risks or gain exposure to markets. When we talk about credit quality, we're basically looking at how risky the bonds are. We see a good spread across different ratings: AAA, RA, BBB, BB, and even some CCC rated bonds, which are considered higher risk. But the big story here is the not rated category, which makes up 39.6% of the long positions. That's a huge chunk of their investments where rating agencies haven't given a formal score, likely meaning these are complex or less commonly traded instruments. This, combined with the large other exposure, hints at a strategy that's on the more aggressive side for a bond fund. And in terms of sectors, the fund is heavily invested in non-US government bonds at 28.3% and emerging markets bonds also at 28.3%. This is where a lot of the opportunity might lie, but also where a lot of the risk can be found. Emerging markets can be volatile, but they also offer higher potential returns. Now let's look at the actual investments the fund holds. This is the real meat and potatoes of the report. We're talking about bonds, and the first section we see is aerospace and defense. Here they've got positions in Boeing Co. with varying interest rates and Matures Inc. Avian 50. They also hold Thales SA and Transding Inc. This section is really where things get interesting and potentially complex. They're investing in a variety of asset-backed and securitized products like commercial mortgage trusts and collateralized loan obligations. Some of these have floating rates tied to SOFR, which is a key benchmark interest rate. For instance, our Sorority 2021 FL1 Limited has a rate of 6.593%, which is SOFR plus a spread. The fund is holding quite a few of these with long maturity dates like 2005, which is a key benchmark interest rate. For instance, Accession 2021 FL1 Limited has a rate of 6.593%, which is SOFR plus a spread. The fund is holding quite a few of these with long maturity dates like 2069 and 2070. The majority of the fund's assets are in bonds, making up 96.4% of the portfolio. This aligns with the fund's name and objective. We've already touched on some of the sectors like aerospace and asset-backed securities, but there's a long list of industries here. A very significant portion of the fund's holdings, 16.3%, are in international market sovereign debt. This means they're lending money to governments of various countries. We see holdings in Australia, Germany, Canada, Japan, Spain, Italy, and the United Kingdom each, with specific interest rates and maturity dates. For example, Commonwealth of Australia bonds with 3.5% due in 2030 Kingdom, each with specific interest rates and maturity dates. For example, Commonwealth of Australia bonds with 3.5% due in 2054 and Federal Republic of Germany bonds with 2.5% due in 2034. This is a huge commitment to global government debt. The fund also has substantial investments in major banks, an area that has seen a lot of focus in recent years. They hold bonds from Bank of America Corp, JP Morgan Chase & Co, Wells Fargo & Co, and several European banks like BNP Paribas and Deutsche Bank. These come with varied rates and maturity structures, most of them being floating rate notes as indicated by FLR. Now let's look at the fund's financial health directly from their statement of assets and liabilities. Their total assets stand at 986600068116 and total liabilities are 24,627,647. This results in net assets of 906.9, the same number we saw earlier, confirming consistency. Looking at the breakdown by share class, we see Class R6 is by far the largest, holding a massive 11,438,76669 shares outstanding. This indicates where most of the fund's investors' money is concentrated. Moving on to the statement of operations, we see how the fund performed over the last 6 months. They earned 227,64533, 1,536,83888, however than 19,683,880. However, they also incurred total expense of 308,137.25 Rs. Up to some reductions, the net investment income comes in at $19.7027 for ore. This is where things get a bit more volatile. They had a net realized gain loss of negative $482.81.82. This means when they sold some investments, they actually lost money overall. Compounding this, they had a net unrealized gain loss of negative $83.58.9. This is on investments they still hold but whose value has gone down. Combining these means the fund had a net realized and unrealized loss of $12,166 for hold but whose value has gone down. Combining these means the fund had a net realized and unrealized loss of $12,160 to N60 $400. Let's check out the financial highlights per share for Class A, the net asset value. At the beginning of the period was $8.25. Their total Brent total 6 months was 0.71%. Now, while that might sound small, remember this is a bond fund in a potentially volatile market. The expenses after reductions were while that might sound small, remember this is a bond fund in a potentially volatile market. The expenses after reductions were $0.14%, which is quite significant given the return. Looking at Class R6, the dominant share class, the net asset value started at 8.20 cents and ended at 8,013 cents. And ended at 8,013 cents, their total return for the period was 0.87%, again relatively modest but positive. The expenses after reductions for this class at 0.61% are lower, reflecting economies of scale typical for larger share classes. So what's the story here? MFS Global Opportunistic Bond Fund is a massive fund operating across global markets and diverse credit qualities. They're actively trading and using derivatives, suggesting a strategy that's not shy about taking on complexity to seek returns. The significant allocation to emerging markets and potentially unrated securities means there's a higher degree of risk involved. While they managed to generate a small positive return for most share classes over this 6-month period, the realized and unrealized losses on their investments are a clear sign of the challenging market conditions they navigated. This fund is for investors who can stomach some volatility and are looking for broad exposure to a key risk to watch is how their substantial investments are. A clear tip, this fund is for positive return for most share classes over this 6-month period. The realized and unrealized losses on their investments are a clear sign of the challenging market conditions they navigated. This fund is for investors who can stomach some volatility and are looking for broad exposure to pet some. What do you think about this fund's strategy? Are you comfortable with that much exposure to emerging markets and less rated debt? Let me know your thoughts in the comments below. If you found this breakdown helpful, give it a thumbs up and subscribe for more deep financial dives. And remember, our Discord community is always active. So jump in and share your insights. Thanks for watching, and I'll see you in the next one.